here is the answer for 1019. This is a more complete activity-based costing question where we're actually looking to see how the overheads are actually applied using individual cost drivers. So the first one we're dealing with, or the first thing we've got to do, is to calculate the activity cost rate for each activity. So here we've got the different activity pools: order processing, returns processing, delivery, rush orders, and sales visits. Their various cost drivers and the estimated indirect costs and the expected use of the cost driver. So that 450 is 450 orders, the 100 is the number of returns. And we're going to use this information to enable us to work out how profitable particular customers are. So let's start. So the first thing we've got to do is to calculate the activity cost rate for each activity. So the allocation formula for order processing is 200,000 divided by 450 orders. So the activity cost rate is going to be $444.44, and we'll just get rid of all those extra cents. Okay, so returns processing is 500,000 divided by 100 returns. So the activity cost rate for that is going to be helps if I put that sign in front of it, 500. Now delivery, we've got $100,000 is our estimated indirect cost for delivery and the number of deliveries. So it's 100,000, the estimated cost of deliveries, divided by 700 deliveries. And rush orders. So the total cost of the rush orders is expected to be 70,000 divided by the number of rush orders, which is 50 rush orders. Now you can see how this is going to help them find out whether a customer is going to be expensive or not. Because if a customer is always doing rush orders, then it's going to actually increase the cost. So you might need to think about putting an extra price on rush orders. And this will help you work out that, the extra price that you need. So number of sales visits. And we've got the, we're expecting to have 100 visits. Okay, so we've got the activity cost rate, and well, let's just get rid of all of these minus bits of cents there. Okay, so now we're going to actually assign the activity costs to each of the three customers, and we've got some information about the customers there. So the first thing for customer 1 is order processing. So customer 1 is 300 times Okay. Customer 2 for order processing. We've got 100. And customer 3 for order processing. It's 50 orders times. Okay. And I'll get rid of all the cents in a minute. Now returns processing, we've got 50 times 500. And for returns processing for customer 2, we've got 25 times 500. And for customer 3, we've got 25 times 500. In delivery, customer 1, it's 400 times 142.86. Customer 2, it's 200 times 142.86, and for customer 3, it's 100 times 142.86. For rush orders, it's 10 times 1400. It's 20 times 1400, and it's 20 times 1400. And finally, we've got the sales visits. It's 50, times 200. $25 times 200. And 25 times 200. I keep forgetting to put that symbol in. Okay, so now we can add up all of these assigned costs. And we can add right across. And now let's just get rid of all of these cents. Oh, we'll leave a couple of cents there. Okay. Now, we're told in the question we've got to get the sales and the cost of sales. We're told that the sales for customer 1 is 300,000, customer 2 150, and customer 3 200. So let's get those in. Customer 3. Okay, so now we've got the sales in. We've got to work out the cost of sales, and we're told that sales are marked up as 50% on cost. So that means the cost of sales is simply going to be And we can carry that across. So now we've got our cost of sales. So a 50% markup means that sales is 150%. So we can work out what 100% of 150% is by simply going 2/3 in this instance. So now we can work out the contribution that the sales make to the profit of the business. And that looks good because remember with contribution margin, we're just looking at the variable costs. Sales less variable costs. So we're just simply going 300 minus the 200. It's 100,000. And we can just copy that right across. So that looks quite good, doesn't it? It looks like customer one is contributing a great deal to the profit of the business. But we haven't taken into account the indirect costs. So now let's look at this in detail. So here we're not looking at less cost of sales, we're looking at less allocated costs. So when we're looking at less allocated costs, we're talking about the cost of sales plus these costs that have been allocated here. So we're going to add these two together. So it's really costing us $439,000 to make sales of 300. So the contribution is that minus that. So we're actually making a loss of 139,000 on customer one. So let's have a look at the rest of them. And how much of a loss are we making here? So we're making a slightly less loss, 68,000. And now let's look at customer 3. So customer 3 is actually losing us less than the other two customers. So what do? Do we get rid of customer 1 and customer 2, or do we do something about working out what's costing so much there? The big costs here for customer 1 are order processing and delivery costs. So if they didn't give us so many orders, if they were much more organized and just sent us 1 or 2 orders, then our costs could decrease. So what we could do is explain to them, if you order more efficiently and reduce the number of orders, reducing number of deliveries, we can still sell it to you at the same price. But if you keep doing like this, we will have to add extra costs to you. So if they go away to someone